Hello, all. Good evening and welcome. I'm Kabir Sohi from the Corporate Communications team of CareEdge. I welcome you to our discussion today on Siemens' next growth cycle from expansion to execution. We sincerely appreciate your joining us for this webinar. We would like to welcome our esteemed guest speakers for today, Mr. Dharmender Tuteja, Chief Financial Officer, Dalmia Cement Bharat Limited, Mr. Jigar Shah, Chief Financial Officer, Wonder Cement Limited, Mr. Sabyasachi Majumdar, Senior Director, CareEdge Ratings. Mr. Arun Kumar will be unable to join us for today's webinar due to some exigency at his end. Going forward, this session will be moderated by Ravlin Sethi, Director at CareEdge Ratings. We will commence the session with a presentation by Sahil Goyal, Assistant Director, and Bhumika Sharma, Lead Analyst at CareEdge Ratings. This will be followed by a panel discussion and a Q&A session. In case of queries, participants are requested to key in your panel. We will take up your queries at the end of the discussion. Now, may I invite Bhumika Sharma to make the presentation.
Thank you, Kabir, and good evening, everyone. The Indian cement sector has historically mirrored the broader economy, expanding at nearly 7% CAGR over the past 2 decades in line with the real GDP growth. Following a subdued FY25, marked by election-related disruptions and slower project execution, early indicators now point to a gradual recovery supported by easing interest rates and improving project pipeline and strengthening infrastructure activity. Simultaneously, the sector is undergoing major structural shifts. Since FY23, consolidation driven by large M&A activities, particularly in the south, and steady organic capacity additions have reshaped the competitive landscape. Operationally, companies remain focused on cost optimization aided by moderating input prices and efficiency improvements. In this context, today's discussion will take a comprehensive look at the key dynamics shaping the cement sector of India. Starting with the demand outlook and growth drivers, we will look at the regional utilization trends and capacity dynamics, industry consolidation over the past decade, and the expected trajectory. Then we'll move on to the pricing environment and the cost side landscape, credit risk profile of the players, and then we shall look forward to what's ahead in the cement industry. Let us now have a closer look at each one of these, starting with cement demand dynamics. Herein, Exhibit 1 on the left highlights the distribution of global cement production. China continues to dominate the industry with a 47% of share, while India stands as the second largest producer, accounting for 11% of the global output, well ahead of other major markets such as Vietnam, the United States, Turkey, and Russia, each of which contributes only 2 to 5%, while the remaining 28% is spread across the rest of the world. This comparison emphasizes not only India's scale, but also its strategic importance in the global cement ecosystem. Moving to Exhibit 2, which looks at per capita cement consumption, the picture tells a very different story. Despite being the second largest producer, India's per capita consumption, which is around 311 kg, remains substantially below the global average of 470 to 520 kgs. This stark contrast, high production share but relatively low per capita consumption, highlights the tremendous headroom for India and its growth in the cement demand as the country continues to urbanize, expand its infra networks, and modernize its housing stock. Having spoken of the global cement consumptions, let's quickly look at the domestic demand trends. Herein, in Exhibit 3, the blue bars are the total cement demand and the blue line is the year-on-year demand growth. Green line is the GDP growth rate. We have tried to segregate this period into different phases since FY15. Over the last 3 fiscals till FY24, cement demand has registered strong growth, closing FY24 at around 9%. FY25, however, saw moderation due to a higher base and Q1 election-related slowdown, as we have seen in the past history as well. During a general election, the demand volatility is clearly visible before and after, as during the election year, the demand becomes low in its low percentage. Delayed project execution and region-specific factors resulting in demand growth of approximately 4% with a cement demand to GDP multiplier of 0.7x. Going forward, for FY26, CareEdge has estimations of GDP growth rate to be around 6%, and accordingly, the cement demand growth rate is projected at 6 to 7%, with a longer-term projection of 7.2 to 8.2% over the next 5 years. This ratio is expected to return to 1x as we move forward and demand gains momentum. Now let's move on to the demand drivers. Herein, in Exhibit 4, we have depicted the key cement demand drivers across different sectors. Now, approximately 55 to 60% of the total cement demand is currently coming from the housing sector, while infra contributes to around 30%, with the remaining share from the industrial segment. Looking ahead, we expect that infrastructure's share is to further increase to 33 to 34% in the coming years, and demand from infrastructure is projected to grow at a robust CAGR of 8.5 to 9.5% over the medium term, driven by the government's strong infra push and higher budget allocations. Having talked about the overall demand drivers, let's take a deeper look into the real estate and infra side of the same. Herein, in Exhibit 5, we have shown the new supply, sales, and unsold inventory in residential real estate. Sales and launches are expected to remain steady, supported by urbanization, rising incomes, infrastructure projects, and policies like RERA, PIME, and Swami Fund. Exhibit 6 highlights the pending houses under the government schemes, under which PMAR, that is rural, has 10.3 million pending units and 2.64 million urban units under the PMA urban scheme, supporting the ongoing cement demand growth. Now, moving to the infra side. Here in Exhibit 7, we have highlighted the key updates in each of the demand engine which contribute to cement demand from infra side. Infrastructure is set to expand its share over the next 5 years, driven by the government's focus on flagship schemes like PM Gati Shakti and increased investments in roads, railways, metros, airports, and irrigation. While the roads are expected to see the highest traction, as under Bharatmala Phase 1, as of February 2025, 43% of the set target is yet to be completed. In Exhibit 8, which is at the right, we have shown region-wise approved under construction and upcoming routes to understand which region may see a higher demand from the metro routes segment. Going forward, the increase in infra outlay is expected to have a multiplier effect across different sectors and set a strong footing for growth and shall keep supporting volumes in the cement sector as well. Going forward, now let's look at the region-wise industry demand drivers. As the sector exhibits regional nuances, we have summarized the demand drivers by region and end user category. The dark green arrows here indicate high demand, while the light green arrows represents moderate demand. Regional growth estimates for FY26 indicate steady demand supported by public investment, urban expansion, and policy initiatives. The central region is expected to lead with a growth of 7.5 to 8.5% in FY26 and 8.5 to 9% in the medium term through FY28, driven by housing demand, metro expansion, and major expressway and smart city projects. The southern and eastern regions are also expected to grow well at 6.5 to 7.5% in FY26 and between 6.5 to 8.5% over the medium term. The northern and western regions are expected to see a stable but moderated growth, with the west maintaining 6 to 7%, reflecting its already mature infrastructure base despite a strong ongoing project pipeline. Having looked at the demand drivers and the demand dynamics, let's look at the supply side. Let's have a deeper look as we begin by examining the pan-India capacity and utilization levels, followed by a detailed analysis of regional utilization and upcoming capacity additions. Here in Exhibit 10, the blue bars illustrate industry grinding capacity over the years. The green line represents the demand growth rate, and the dark blue line indicates capacity utilization rates. Over the 5-year period up to FY26, the supply pipeline stands at nearly 160 million tons, compared with the expected demand growth of around 115 million tons. Historically, annual capacity additions range between 20 to 25 million tons, but in the current year alone, we expect additions close to 50 million tons. This is largely driven by the improved medium-term demand outlook and heightened competitive intensity with manufacturers, particularly large players, announcing aggressive expansion plans to consolidate their market share. By the end of FY26, total industry capacity is expected to reach around 725 million tons, and based on the announced capex plans, the sector appears to be on track to reach 900 million tons by FY30. While capacity is expanding rapidly, our estimates suggest that demand will grow at a higher CAGR than supply over the longer period. Regionally, the south and east continue to lead the capacity additions, followed by the central and northern markets. CareEdge ratings expect demand to back up the upcoming capacities. Hence, no significant decline in the utilization levels is expected, and it is estimated to hover around 68 to 69% at the industry levels by FY26 end. Having looked at the pan India utilization and capacities, we are now moving to regional utilization levels. This slide exhibits region-wise capacities expected to be added over the next two fiscals. Exhibit 12 provides a brief overview of region-wise demand and supply CAGRs, while Exhibit 11 depicts the projected impact of these changes on utilization rates. In the north, demand and capacity growth are broadly aligned at 6 to 7%. Capacity utilization is expected to remain steady in the range of 83 to 85%. The South continues to record the lowest utilizations, reflecting its structurally high capacity base, also having the largest capacity pipeline at 36 to 38 million ton. In the East, with both demand and capacity growing at 7.5 to around 8%, the East shows a near perfect alignment between incremental consumption and upcoming capacity. While in the West, utilization has firmed up to owing the healthy demand recovery. In the central region, demand growth is estimated at 8.5 to 9%, exceeding capacity growth of 9 to 9.5%, with a similar capacity addition plan of 27 to 29 million tons. Moving on, let's now examine sector consolidation. Herein, the graph highlights the steady rise in market concentration. The top four players, who accounted for 47% of the industry volumes in FY12, increased their share to 52% by FY18 and further to around 60% in FY25. Based on current trends and ongoing consolidation, we expect this share to rise to 65 to 67% by the end of the year. Another noteworthy trend is the growing dominance of the broader leadership group. The top 9 players together now account for 81% of the industry volumes, compared with 58% in FY12. This indicates that even mid-sized players have managed to scale operations and keep pace with demand growth. By year end, this combined share is expected to reach around 91%, primarily driven by further gains among the top four. Looking ahead, this momentum is expected to continue. Now, let's look at the next slide. Increasing competitive intensity and consolidation. In Exhibit 14, we are highlighting the clear and accelerating consolidation trend in the Indian cement sector. The capacity share of the current top four players has expanded materially, from 35% in FY12 to 56% in FY25, and it is further projected to reach 61% by FY28. This shift reflects a decisive change in the industry structure as scale, integration, and access to capital increasingly shape competitive advantage. A substantial portion of this gain has been inorganic, driven by acquisitions of both regional operators and stressed assets. Exhibit 15 reinforces this. Of the 141 million tons capacity added by the top four players over the past decade, a significant 45% came from the acquisitions. The FY23 to 25 period alone saw 98 million tons added, nearly 70% of the previous decade's expansion, underscoring the rapid pace of consolidation. Meanwhile, the mid-tier cohort, players ranked between 5 to 25, has seen its share compress materially, falling from 48% in FY12 to 34% in FY25 and expected to slide further to 29% by FY28. Much of this reduction stems from these companies being absorbed into larger groups through M&A or IBC-led transactions. This trend is set to continue as several ongoing deals and brownfield opportunities move toward closure. The beyond top 25 segment has remained relatively stable in share, though its role is diminishing as the market concentrates around scale-intensive operators. Overall, the exhibits show a sector moving rapidly towards greater concentration, with top four players driving expansion through a combination of targeted acquisitions and steady organic growth. Their ability to consolidate fragmented regional markets, optimize freight efficiencies, and deploy capital at scale positions them to continue strengthening their market share through FY28 and beyond. Now, I would like to hand over the session to my colleague Sahil, who will take you through the cost and price elements as well as the financial and credit profiles of the players.
Thank you, Bhumika. On this slide, we look at how key cost elements have moved in recent years and what to expect in FY26. Raw material costs, which typically form 16 to 20% of total cost, have trended up since FY23, though not all of the limestone costs may be classified as raw material since major players have captive limestone reserves. While major players benefit from captive limestones, CareEdge ratings still expect a marginal increase in FY26 due to higher costs from newer mines and rising fly ash prices. Freight costs have remained stable at around 30 to 31% of the cost structure. Power and fuel continues to the influential cost driver after spiking to 35% in FY23. They eased to 31% in FY24 and further to 28% in FY25, supported by lower petcoke and coal prices, with expectations of further softening in FY26. These buckets should decline slightly. At the same time, players are increasing shifting to greener power through WHS, wind, and solar, which is helping reducing long-term energy costs and emissions. As shown in Exhibit 7, overall total cost per ton rose sharply from FY21 onwards before moderating in FY24 and FY25. For FY26, CareEdge rating expects cost to stabilize around 4,460 to 4,490 per ton, lower than FY25, but structurally higher than pre-FY22 levels. Overall cost volatility is expected to remain limited in FY26 with a mild downward bias. Moving to power and freight trends, these two cost lines have shown distinct but important patterns over the past few years. Starting with power and fuel costs, shown in Exhibit 18, that per ton cost rose sharply in FY23, driven by the spike in global petcoke and coal prices. However, with supply chains normalizing and global fuel prices cooling off, this cost moderated to 1,444 per ton in FY24 and further to 1,258 per ton in FY25. For FY26, costs are expected to moderate slightly. Despite this normalization, geopolitical events may continue to cause price volatility, which remains unmonitorable. On the freight and packaging side, as illustrated in Exhibit 19, costs also increased in FY23, followed by decline in FY24 and FY25. For FY26, costs are expected to remain broadly stable. In the cement industry, price traction has remained elusive over the past 2 years. As shown in Exhibit 20, net sales realization had improved steadily from 4,952 per ton in FY20 to 5,611 in FY23, reflecting a CAGR of around 3%, supported by healthy demand and price hikes. However, realization softened to 5,500 levels in FY24 as competitive intensity increased and pricing discipline weakened due to election-related disruptions and erratic weather, which also led to quick rollback of Q3 price increases. In FY25, realizations declined further to around 5,250 per ton levels, a drop of nearly 5% at the pan-India level, though the magnitude of correction varied across regions. Demand moderation and softer input costs also curtailed the industry's ability to take meaningful price hikes. For FY26, realizations are expected to improve only marginally by 2 to 3%, settling in the range of 5,350 to 5,400 per ton for the full year. However, with substantial new capacity additions lined up across regions, structural pricing power is expected to remain limited, making supply-demand balance a critical monitorable going forward. Now, let's connect all dots. As shown in Exhibit 21, which presents a waterfall chart of EBITDA per ton for industry average and highlights how each key driver has shaped profitability over the period. Realizations declined in FY25 because demand was muted and competition intensified, putting pressure on cement prices. As a result, even though power and fuel cost eased, the overall profitability still dropped, leading to about a 13% fall in PBLT per ton, which reached to around 822 levels in FY25. Looking ahead, PBLT per ton is expected to improve to 950 to 980 levels, slightly ahead of FY24. Improvement in sales realization and continuous easing of power and fuel costs are expected to drive the recovery. Demand revival, which will support higher sales volume and better realizations as improved market conditions allow companies to sustain price hikes more effectively. Overall, while FY25 saw profitability being squeezed up by weaker prices, FY26 is expected to bring a notable improvement as both demand and pricing conditions strengthen. Exhibit 22 shows the movement of return on capital employment along with PBLT per ton and revenue growth. PBLT per ton remains volatile over the past years and dropped sharply to 761 in FY23 due to elevated levels. It recovered in FY24 but softened further to around 820 in FY25 as demand remains subdued and realizations weaken. Accordingly, return on capital employed remains moderate at around 6.2% levels in FY25. A recovery is projected in FY26, with PBLT pattern improving to 950 to 980 levels and ROCE rising to 11 to 12%, supported by better realizations amidst demand recovery and moderating costs. Exhibit 23 illustrates the net debt to EBITDA range across AAA, AA, and A rating bands. As visible, AAA rated players consistently operate at the strongest leverage levels, with net debt to EBITDA remains near or below zero in most years, while AA player shows a wider range and A rated players operate at competitively higher leverage. Across categories, net debt to EBITDA improved steadily from FY19 to FY22 before seeing a temporary spike in FY23, led by elevated input costs and increasing working capital borrowings. In FY25, leverage moderated slightly as players incur incremental debt to fund ongoing organic expansions and inorganic acquisitions. Despite this, AAA and AA players are positioned to maintain strong coverage, supported by healthy cash generations, while mid-sized A-rated players are expected to operate at moderate but stable leverage levels. Exhibit 24 represents the segregation of 28 players rated by CARE ratings across various rating bands, which forms around 78% of the total installed cement capacity in India in FY25. It may be noted that 99% of the capacities from the CareEdge universe falls within the investment grade category. Being a consolidated industry with long-standing and interest players, significant 40% of the rated portfolio falls in the AA and above categories. Also, not much rating change have happened in last 1 to 2 years, since credit profile of most players should significantly improve on account of deleveraged balance sheet, despite players have been battling with the cost wave and its weight on profitability. Now, with this, we come to the last slide. To summarize the way forward the sector, infrastructure spending is expected to remain a key policy priority, which will continue to support healthy cement demand. We see demand growing up 6 to 7% in FY26 and sustaining a 7 to 8% CAGR over FY26 to FY30. Capacity additions are set to pick up pace, led largely by the bigger players, with inorganic expansions expected to play a meaningful role in the medium term. ESG commitments and cost efficiency measures will remain central theme, and the overall credit profile of the sector should stay stable, supported by strong balance sheets that allows company to comfortably fund their capex plans. At the same time, a few monitorables are fuel cost volatility, especially post changes in the MMDR Act, which may shift the cost curve. The sector's ability to take sustainable price hikes and lift EBITDA per ton beyond the 1,000 mark will be crucial. Additionally, if profitability improves slower than expected while capacity intensity remains high, coverage metrics could see some pressure. Further, any emerging demand-supply imbalances, given the upcoming wave of capacity additions and any deviations in key demand driver, is key monitorable. Overall, the sector enters the next cycle on a solid footing, backed by demand resilience, capacity buildup, and healthy financial strength, but with a close eye on cost trends, pricing improvement, and execution of new capacities. We now have come to the end of the presentation. Thank you, everyone. Now I will hand over to Kabir.
Thank you, Bhumika and Sahil. Attendees are requested to key in their questions, which we will take up after our panel discussion. Now, may I invite Ravleen Sethi to take over the session, please. Ravleen Sethi serves as a director at CareEdge. She is qualified chartered accountant with over 14 years of extensive experience in corporate accounting and credit rating. Throughout her career, she has demonstrated expertise across a broad spectrum of industries, including cement, hospitality, healthcare, and sugar, among others. Over to you, Ravleen.
Thanks, Kabir, and thank you, Bhumika and Sahil, for setting the context through the presentation. So, to unpack the different industry perspectives and help us decode what the next few years would look like, we have with us an eminent panel of industry veterans. I would like to begin by inviting our panelists to join in. First, we have with us today Mr. Dharmendra Tuteja. He's the Chief Financial Officer at Dalmia Cement Bharat Limited. And Mr. Tuteja has over 34 years of experience across finance, commercial, and business management. He's currently serving as the CFO for Dalmia Bharat Limited and Cement Bharat as well, and has been associated with the Dalmia Group for past 1 decade. Prior to this, he served various groups on key positions like Samtel Group's Controls and Switchgears, Cripco, and Sale. And he's a member of the Cost Accountant of India and also Company Secretary of India, and as an alumnus of Sri Ram College of Commerce. Welcome, Mr. Tuteja.
Thank you, Ravi.
Next, we have with us Mr. Shukla would not be joining us today due to some exigency, as Kabir mentioned. So we have with us next Mr. Jigar Shah, who's the Chief Financial Officer with Wonder Cement Limited. Mr. Shah has been having over 18 years of experience in finance and strategy with prior roles at Vedanta and Kalpatru Group. At Wonder, he oversees the financial planning, the treasury, the accounting, the audit and taxation, and has significantly contributed to the company's growth trajectory. He's a chartered accountant by profession, and we look forward to your views. Welcome, Mr. Shah.
Thank you so much.
Also, we have with us today Mr. Sabyasachi Mazumdar, who will be joining us. He's a senior director with CareEdge Ratings and has over 25 years of experience with rating agencies. He's an alumnus of IIM Lucknow and is heading the power sector along with major corporate sectors at CARE from last 2 years. And prior to this, he's been working with ICRA for over 2 decades in his previous role. Thanks, Sabu, for being on the panel, and we'll have some credit views as well.
Yeah, thanks, Ravleen, and thank you very much, Mr. Tuteja and Mr. Shah, for taking your time out for our event, and thanks to Sahil and Bhumika for making a very informative presentation on this sector.
Great. So I welcome all the esteemed guests on the panel once again. And to open the discussion, I would like to pose the first question to you, Mr. Tuteja. We saw moderation in fiscal of 25 in demand, and we've been talking on it. So with elections behind us, how do you see the demand building up now, since we are entering the seasonal second half of the year, and also maybe, a step ahead, maybe fiscal of 27 as well. So what is the base case growth, estimate that you're looking at?
Okay. First of all, let me congratulate the entire CareEdge team. I think it was a wonderful and very comprehensive presentation. Kudos to the team. Well done.
Thank you so much, sir.
Okay, coming to your question, I think let me first address the Indian economic growth, because that is the major factor which determines or affects the cement demand growth.
Sure.
So with this GST cut, I think ball has been set for a strong trajectory of economic growth. So in spite of the geopolitical and this tariff concerns, still we expect the demand growth or the GDP growth in the country to be about 6.5 to 7%. And of course, almost daily we keep getting some cues that this tariff war should also be behind us very soon. Hopefully within this quarter, we should see that Indo-US treaty to be signed. And besides this GST rate cut, the interest rate cut 1% has already been done, and before March, at least one more cut of 25 basis point, maybe at least 50 basis point also can come. So that is also going to help the further boost in the economic growth. So with these factors, I see that economic growth is going to be strong, and that is going to help the cement demand growth also. As you already covered in your presentation, rural housing is doing well. Urban housing is slightly lower, primarily because of the high elevated prices of real estate in the some urban pockets. But of late, we have also seen that many realty players, they have bought significant land. The land purchases of these players in 24 and first half of 25 is significantly higher than what they did in last 2 years. And they are already sitting on a low inventory of the unsold built up stocks. So these are well for going forward. We expect that more launches will come, although in the recent past launches had reduced too. And one more change which came recently in the monetary policy was that ECBs have been allowed on the real estate wherever the FDI is allowed. So, and financing was one major concern for the real estate players. So this also has been addressed. So considering these factors, I still feel that going forward with GST rate cut, the affordability also improves. So with these things, next medium to long term, and especially next 18 months, I expect at least 7 to 8% growth on the cement side. I think that should be the base case.
Okay. No, great. That's a great insight and sets a very strong context as well. So GST and interest rate cuts, even though muted 25, we see a clear rebound happening in H2, and obviously 27, like you guided, looks stronger from your perspective, maybe a 7 to 8%. Okay.
On the infra side also, if I see that government spending has been strong in the first half, But if I see the spending of the Ministry of Housing and Development, their spending has not been that strong. So they have catch up to be done in the second half, which will be helpful. And of course,
Sure.
government commitment to capex spending remains strong. This year, budget is about 3% of the total GDP, which is unlikely to go down in the coming years.
No, got that. So we note those, so those are the clear demand drivers for the H2, and then obviously we head towards a stronger 27 as how I understand these points. Let me get in Mr. Shah over here. How do you see India structurally? We've been adding capacities every year. I mean, 26 would be a year where we'll add a significant capacity, as we just saw in the presentation. So is India structurally capable of adding 40 million tons of incremental demand every year, like we've been adding capacities? Or you feel, gradual tapering would happen, and the aggressive expansion cycles, do you believe demand will keep pace with like close to 200 million ton, which we just spoke of in the presentation, getting added by fiscal of 28? What's your view, on the demand side?
Yeah, sure. So, good evening. First of all, thank you, CareEdge team, Sabya, Sachi, Ravlin, and entire team for hosting this webinar and such a nice presentation with in-depth understanding. So, what Tuteja sir has mentioned, I fully agree that see there is no concern about future which is left out on table. So that all blocks are in building blocks are in place basically. So, however, the concern is that see last 18 months were not as per expectation of the industry. Even if we recall the similar analysis year before or 18 months before, we all are expecting the growth of similar region where similar level where what we are expecting around 7% or so. But last 18 months we are behind that target.
Correct.
So that is the first thing. Second thing is see if we'll see the long term demand growth, say last 15 years. So that is around 5.4% CAGR, and particularly last 3 years when the capacity addition is to the tune of around 28 to 30 million ton pan India. So that much capacity we have added last 3 years annually. So between 25 to 30 million ton each year. And we are now talking about adding further 35 to 40 million ton per annum, which we have announced projects in the various region,
Correct.
totaling around 180 million ton odd in till FY28. Okay, so demand definitely will not able to cope up with this capacity addition. Even if we'll consider the moderate growth of say around base case 7% growth, demand growth, then also the capacity addition will be at a much higher speed, considering the 35 to 40 million ton addition. So that the concern. So we all remain hopeful and favorable that the demand growth will surpass this base case of 7%, and we wish that the demand growth can be on a higher trajectory than the 8.5% or so, to match the pace with this 35-40 million addition, because the announced project which are already in pipeline that will going to complete by 28. So that capacity addition is more certain than the demand as of now.
Sure, sure. So capacity additions may not be homogeneous at regional levels for sure. Some
Yes,
regions may see higher incremental capacity. So
true.
maybe at a pan-India level, our view is, the demand will keep pace at a national level could be, but some pockets in the region-wise may see, a higher incremental capacity coming up, at least in the short-term blips, like you just mentioned. So this may lead to the competition intensity also in those regions,
Yes,
possibly.
yes.
Okay, okay. So, Mr. Mazumdar, maybe moving to you, Sabu, and getting on a credit perspective, how do you feel? We've been obviously we have our in-house view on the demand side of the infra as well. For 26 and 27, do you expect the demand engine to be infra-led or real estate-led, like Mr. Tuteja just mentioned few points on the urban and the rural side? And how strongly are these early signs, like signals kind of signaling, or what are the big signals?
So let me first begin with a disclaimer. We know that a fair amount of demand, although we can't quantify the exact amount, comes from housing demand in rural areas or very small towns, and a lot of it is really dependent upon what happens on the farm income, how the agricultural sector fares. So we need to keep that in mind that whenever you're talking about a future year, the farm income to a great extent depends upon the weather conditions, whether the monsoons are regular or excessive, or there's a doubt. So we must keep some amount of allowance for that. That can, make some difference in, what will the composition from infrastructure segment, how much will be the composition from, let's say, the urban housing segment, and how much will be from rural housing segment. So let's keep that in mind. But if I was to look at the broader picture from our assessment, FY 26-27, assuming business as usual conditions, neither extremely good monsoons or very poor monsoons, I would think would be infrastructure heavy, supported by roads, metro projects, water supply, as well as spending spillovers. For instance, some of the projects which didn't get completed because of elections, as well as code of conduct being placed, those would be completed. So that will create a demand. Overall, the real estate sector remains resilient, particularly the urban development and redevelopment and premium housing. Although on the affordable housing segment, the recovery is still uneven.
Yeah.
As far as the urban demand indicators are concerned, things like project launches, cement dispatch trends, logistics movement, they remain encouraging. Rural demand is also improving slowly, helped by farm income normalization with a good monsoon this year, Manrega's support, as well as PMA-G momentum. However, it's not uniform across the states. And regionally, I would think that central and east appear to be stronger due to large public infra pipelines. Plus, we must also remember that these are also the regions which are the relatively poor parts of the country, and having a low base effect and low consumption, chances are
Absolutely.
that they are likely to have a higher growth rate compared to more mature segments like South and West. Particularly, in South, they are fairly developed parts of the country. Large amount of the infrastructure which had to be built have to a great extent been built. Perhaps Central and East would have a somewhat higher growth rate compared to the rest of the country.
Sure. Thank you. Thank you, Sabu. So message is clear. Maybe infra stays the dominant growth driver. That's across the house, I believe we all will believe. But urban real estate is kind of strengthening, and rural, like the points we just kind of spoke on. So maybe let's move to the next theme, and Mr. Tuteja, I'll appreciate if you can share your insights, like we spoke of the demand, and could be a 7 to 8% is a longer term view that we see. Some blips we'll always see pre-election, post-election, but from a long-term perspective, could be matching to the GDP, 7 to 8%, like you said. So, do you see the capacity additions trend shaping over the next 2 3 years? We've shown in our slides or our presentation that close to 200 million ton is coming up in the next 3 to 4 years, and players are very, aggressively doing that. And right now, whatever is stated in the public domain is kind of matching as well to whatever the capacities get commissioned. But should you believe that the demand moderates, for any reason, like we've seen in the past 18 months? Is a slowdown in the expansion cycle likely, by the players, just to probably keep the balance sheets healthy? Also, since we speak on the capacity addition, could you also, you have capacities across major regions. So could you also just give us a flavor, are we having enough limestone reserves to support the planned capacity pipeline? And because there are a lot of regulatory standpoints also which will come in over here. So we'll appreciate your views, please.
Sure. So first of all, this strong pipeline of the new capacity additions, and primarily from the bigger players, that clearly shows their conviction about the India growth story and the cement growth story. That means they are deeply convinced that, okay, quarter by quarter, things may not work out the way you plan, but long term, there's a clear future, bright future for the industry. That is the reason why these capacities are getting set up. Number two, as your presentation also showed, that the increase in capacities is almost in line with the demand growth. So practically the utilization levels are not improving, or they may improve only marginally over the next 4 5 years. If you say that, okay, 1 2%, as you rightly mentioned, that is the growth we expect. So capacity utilizations will still remain under pressure around 70% only. And this definitely will ensure that the competitive intensity will remain high. And of course, whenever any moderation happens in the cement demand, the first 1 or 2 years, for example, if you are talking today, the capacity is coming up in the current year, next year, I don't foresee any deferment of those capacities. They'll come definitely on course. But capacity is coming up in the third, fourth year. Naturally, there would be a tendency to defer that by 6 months, 1 year, because honestly, if the demand is not catching up, people will not like to put up the capacity at the fastest rate. There could be some slowdown right there. And coming to the limestone, I still feel that although there has been some exploitation of the high-grade limestone reserves across the country, but still there's enough limestone availability across the country, and of course, pocket to pocket, state to state, they may differ. But availability of limestone is definitely there in these states wherever the capacities are coming. Because with the use of petcoke, which is now very common and standard in the kilns, you're able to use limestone even with a lower lime content.
Correct.
And sometimes you're able to blend it with a high-grade limestone. And if we see the data of IBM last publication, which is there, although it is still dated, the results which they are showing is 19 trillion, that is as of 1st April 20, as per IBM yearbook of 23 published in January 25. So only 19 trillion reserves they are showing versus the 227 trillion resources available. So reserve to resources ratio, they are mentioning only 8%, which is very
Okay.
any person who is knowing, understanding the mining will know that the ratio of reserves to resources is significantly higher, at least upwards of 50%. So what you would have seen that in the past, people keep increasing their reserve declaration as they
Correct.
dig deeper and deeper. So the data which is there in public domain is much lower than the actual reserves. And with technology, of course, as I said, they are able to use limestone with the lower lime content. So I don't foresee next 25, 50 years any challenge on limestone. There could be some pockets, let's say state of Tamil Nadu or some state where the availability of limestone may not be as comfortable as state like Rajasthan or Andhra Pradesh. But now with the new policy, now railways announced that you can move cement at 90 paisa per ton per kilometer. So cement can move from nearby state also. So capacities will definitely get situated wherever the limestone reserves are comfortable. And I don't see this will be a challenge for the upcoming capacities.
Okay. So the message would be maybe for the next 2, 3 years, we'll see a fairly elevated commissioning. Like you said, what players have spoken, those capacities will be coming on board. Maybe if the demand is not matching up, maybe from the year third or fourth, we see some tapering. That will be obviously a call. And reserves are not a binding constraint at the national level.
Yes.
Great. So, Jigaji, if we just kind of get, your thoughts in the current capex cycle, like we just spoke of, and there could be a tapering of the capacity coming in just in case the demand is not matching. But what do you feel, is the capex cycle strategically driven more from a market share or regional dominance perspective? Though we'll talk on consolidation a little, as we head in the discussion. Or is it fundamentally demand backed and the India's growth story, what we've been talking about? Like, how do you feel about it?
See, surely that the expansion which is announced by the all the players, rather it's a big or whosoever announced that capex, and that is with the full conviction on the India story, consumption growth, and the all the economic factors in line. So that is a fundamental for any capex driven decision. Apart from that, it's a secondary aspects that in which region we want to go and enhance the capacity. That is a secondary aspects. Definitely, that is also in discussion that how my market share is moving in particular
Yeah.
region to region, and what this new expansion or new capacity addition will bring the company to be. But primarily, it is always a demand driven only.
Okay, sure. Sabu, maybe, over here, we as we move on to the pricing thing, and before I get on Mr. Tuteja and Mr. Shah's view, how like we spoke of the utilization levels across all regions. At what utilization levels, since you've seen the sector over a past many years and the cycles like you've been with ICRA as well. So what utilization levels at industries, maybe grinding or clinker, do you feel that the industry regains the meaningful pricing power?
So, historically, what we have always observed is that once the industry comes to a, close to, let's say, 75, 80% kind of capacity utilization, that is the time when, the pricing power, comes back to the industry. But at the same time, we have also seen that, the pricing is not purely a function of the capacity utilization and supply demand. We also, a lot of is also dependent upon the producer behavior, as to whether, the producers are aggressively seeking market share, even at the cost of dropping prices, or they are more comfortable having let's say respectable level of profitability and prices, and maintaining market share rather than aggressively chase it. But having said that, the supply demand position is the biggest determiner of price levels, and historically about 75-80% would be the kind of number you'd like to see before, I mean, you're likely to see before there's a substantial build-up in pricing. Right now we are in the low 70%, and given the very large capacity expansion programs which have been drawn up about 180 to 200 million tons over the medium term, and obviously the demand will only grow at a particular level, let's say 6% to 8%, depending upon the GDP growth. So it would seem like over the next 3 years at least, the overall utilization improvement will be fairly gradual. So while we can say that the demand outlook is supportive, the supply side will keep the industry away from reaching that kind of threshold of capacity utilization, which will cause the prices to pump upwards.
Okay, okay. So we move on with your views to Mr. Tuteja. So do you agree with what, Sabyasachi just said? Do you concur his view? And
Totally.
also, do you see competitive pricing intensifying further, or, will it be a more realistic approach, and will it be a price-led market over the next 12 to 18 months? Though we, as a rating agency, we have our views and we've seen price improvement happening in 26. We see some price improvement should happen as we exit the year over 25, but still looking forward for your views.
Yeah, I agree. I think broadly, whatever Sabyasachi ji said, and this strategy of volume versus margin, I think that pressure continues throughout the year, and sometimes some player may play one strategy in one region, another strategy in another region, depending on what their goals are in that region. And one clear shift we noticed in the current year was shift towards priority over the margins compared to volume. That is the reason we saw that prices improved in the first quarter, especially in southern markets, and eastern markets had started improving from the last year, quarter four onwards. And that kind of tendency we foresee that will still remain, because ultimately companies are accountable to their shareholders for the return on capital employed. A lot of acquisitions have been done, which will not justify the paybacks or the return on capital employed if the prices remain low. So I'll see that even though the pressure will remain to increase market share and drop prices, but again, somehow the expectations of stakeholders will also be to generate higher EBITDA margins. So this pressure will keep continuing, and quarter three also is slightly lower as compared to, let's say, quarter two. But as the market improves in quarter four, I foresee that prices will start increasing.
Okay, okay. So apart from the cost efficiency gains, it will be pricing gains also that will flow into the EBITDAs as we move ahead.
Yes.
Great, great. Uh, Let me, take the conversation a step ahead. Jigaji, if you could please help us, what's your view in the EBITDA per ton improvement in the next 12 to 18 months when you see from an industry perspective? So a lot of players, including the big players, have announced cost levers improvement, and we continuously track those, and, people have kind of worked on. Every cement company is moving towards the improvement of the cost efficiency. And do you also concur with what Mr. Tuteja said? And is recovery and realization will be a big trigger for the next 12 to 18 months from an EBITDA improvement? And also a link point, the cost optimization, like I just spoke of, it's kind of becoming a race to bottom in the absence of the pricing discipline what sectors saw. So how do you see, these two levers of this industry?
Sure. So, first thing is about the cost levers, which industry has experienced, witnessed, and expertise over last, say, 24 months. That is primarily that cost saving has come through the large two buckets, which is power and fuel,
Correct.
primarily driven by the mix of the renewable powers against the thermal power, which historically the industry is using. So that is a major shift which we have witnessed. The journey is midway because majority of the RE power has come in play, and other more than 40-50% will come in the next, say, 8 to 10 months, 12 months kind of thing, which industry has initiated. So that major shift has come by way of the usage of the renewable power. These alternate fuels which industry has used, and it's quite mature now. So majority of that is a single location, single kiln plant that people are using up to 20-25% at a single location, and the larger plants are using 5 to 10% based on the size of the clinkerization at the single location. So, and the third one is about the usage of the conditioned fly ash, which earlier was a concern while using that, and the industry is dependent only on the dry fly ash. So these are the three major initiatives which industry has witnessed, and obviously that recipe optimization based on the available that based on the along with the petcoke, which Tuteja sir has also mentioned, and one can use the optimize the usage of the high grade limestone to that extent. So recipe optimization, these are the all the levers were on fires in last couple of years, and now the balance that available juice in that particular cost reduction is primarily in the RE power only. Okay. And because route optimization, lead optimization, everything has witnessed to some extent. Now the
Correct.
leftover is the only capex lead, which is a large capex item, which railways has also announced that based on the bulk cement and all that, but that is a large capex driven projects. So now the further improvement will come. One part is along with the leftover potential from the cost aspects. The another one is through the margin improvement. Margin improvement, and by even by moderating the utilization by couple of percentage, actually it will give much more gain from the margin margin side itself to the industry, and that will remain a good strategy to keep the balance sheet and profitability at the healthy level. So
Okay.
definitely that potential and further focus will be there to improve the margins and price relation, because the prices has continuously lowered in the after first quarter one end, and now we are hopeful that based on the demand driven, that again the demand will be good in the coming following months, 4-5 months of this financial year. So prices will take a traction from here, and we see the margin improvement by way of pricing also for even next 4-5 months, and continue to be in FY26 with the healthy pricing.
Okay, okay. So your take is also because prices have been very, very elusive in the sector. At least in the last 18 months, we have not really seen much of the improvement coming. So 21, 22 were the two good years from a price perspective, and post that there has been at least a stability, but the last 18 months has seen a lull from a price perspective. So you also see prices moving in a healthy direction as we head forward, and cost would not be the only lever.
Correct. And one more thing that which perhaps that the main intention for GST reduction, that is to give boost of the demand. And even the industry as a whole, we all are anticipating the demand of 6 to 7% demand growth, or 7 to 8% also, even without the GST rate reduction. So now, given the GST rate reduction is there, so there is a more power in the hands of the consumer, more benefit in the hands of consumer. Demand has to go up sharply, and hence the margin improvement must be there with the hands of the industry, by
Okay.
way of either by way of demand, cost reduction, and followed by the pricing.
No, no, those are very valuable insights. Thank you so much. And we move on to the last, leg of the discussion, which is consolidation, though the most hot discussion out in the sector right now. So, Mr. Tuteja, if I can, begin with your views. The large consolidation, in the last 18 to 24 months, we've really seen a large consolidation wave of the sector, and it was near to its tail end. Do you see there would be another phase of the big ticket M&A happening? Also, if you can just help us, like in our presentation, we've spoken that the top four players, they control 60, they would be controlling close to 60% of the capacity by fiscal of 28. Do you see this would be reshaping the competitive intensity and the pricing behavior post then? We've been speaking, we've been speaking is the next 2 to 3 years, but post that, would it really shape the pricing behavior of the sector? Maybe a macro view, would help our audience as well.
Sure. So the consolidation swing, which is continuing, I think is going to continue going forward also. And definitely all the big four players will cross the 60% of the capacity share, as you mentioned, by FY28. And that will definitely help to improve the pricing power as well as the discipline, which we have seen post-acquisition of capacities earlier by wholesale. So those things were evident in the behavior. Whenever consolidation happens, prices tend to improve and profitability comes to the industry. So we can expect going forward also.
Okay, okay. So maybe the blockbuster acquisitions may be tapering, but strategic consolidations would kind of
Will
continue. It
continue.
could be
That
moving
is,
to region specific or
yes,
acquisition of the could be to gain the limestone access maybe as we move ahead. Okay, okay,
definitely.
great. So, Jigaji, if we kind of move on to, what are your views on the consolidation, because we would like to have diverse views from a consolidation perspective. How do you see the consolidations shaping up in the sector?
See, I learn a new word, that blockbuster period for this consolidation. Okay, so that will definitely. So there is a desperate call by the and entrant call for that particular players, that for acquisition and the race for the number one. Okay,
Yeah,
so that blockbuster period definitely will not be there. And since the lot of greenfield and brownfield expansions already announced by the larger player also,
sure.
my personal view is that intensity will be on a lower side for that acquisition part. Only that it will be rightly said that it will be strategic things. So, for example, if particular pocket, if the market share is not there, or if the limestone reserve is available with the smaller player, that it will be definitely opportunity for the larger player to look for that M&A activity. But otherwise, it will be on a lower end only, and not will be the blockbuster kind of thing.
Okay, okay. We stay with you, Jigarji. If you could help us, how are you seeing the biggest structural disruptor to the industry, going forward from over here? Would it be
Sure.
the alternative
Yeah.
binders, the carbon cost,
So,
green cement?
correct. So just moving for before that question, that also the one more thing is that now the larger player understand that the cost of putting the greenfield or brownfield will be comparatively cheaper and economical compared to the M&A activity, which is not now the priority to go for a
Correct.
$90, $100 kind of acquisition, when we can put at $60, $70 kind of a given greenfield also. So that's the another part.
Sure.
Now, a disruption part of the, it's not any immediate threat or any immediate disruption is noticeable. Though we are talking about the green cement part or binder one, which you mentioned. So, but I don't foresee any major disruption part which will come into the or foreseeable in the at least medium term kind of a thing. However, we'll look for your views particularly on this subject. I don't have any
Sure.
particular view, that I don't foresee anything basically.
Okay, okay. So, Sabu, maybe, can you help us with how do you see a structural disruptor to the industry? Could be maybe in the medium to long term?
So in terms of the overall consolidation, the largest, transactions are behind us. But if you look at the overall industry, still there are a large number of, small to the industry is still fragmented outside the top four. We still have a lot of, mid-size or even small-size regional players which are still there, which have aging assets or limited, let's say, limestone reserves or single plant operations with relatively weaker balance sheets, who could still be acquisition candidates. I mean, many of these players may want to sell out because they don't see themselves as, graduating to the higher level. So the next wave will be more, strategic and regional.
Okay, okay. Thank you. Thank you so much. So let us just move to the question and answers. We a lot of our attendees have kind of posted questions. Maybe I'll pose this to you, Dharmendra sir. One of the attendees is asking what structural shifts such as new age technologies, the low carbon cement, or maybe similar to what we asked, is the next phase of growth for the Indian cement sector. The participant is asking, what would be the new age technologies or a low carbon cement from a new phase of growth for the Indian cement sector as we evolve forward?
Definitely the use of renewable power, use of the alternate fuels, this is definitely going to be there. And definitely the proportion of the blended cement, which helps to bring down the carbon density of the cement, that
Sure.
is going to be the norm. A lot of public sector or even the government tenders, we have seen that they have moved away from OPC as a pre-qualifying cement to even PPC or PSC. So that is helpful, and ultimately, future growth in the industry has to be on decarbonization, definitely.
Okay. Okay. Great. We move on to
Also,
the next.
Naveen, in
Sure.
terms of low carbon cement, I mean, one of course is, the higher usage of, renewable
Renewables.
power in the, grinding side, of course, is a given. Now, people are also talking about, how to get into low carbon on the clinker side. I mean, how to, replace the fossil fuels with, green, green heat, basically. I mean, using either renewable power or some other methods to do the heat. A lot of R&D is going on, but still, I think things like green hydrogen and others, still they are quite some distance away till, they can be, cost competitive with the conventional fossil fuel. And it also depends upon, I mean, if they are more expensive, it really depends upon, regulatory action and how much the society is willing to bear a higher price for, green, green costs on the kiln side. There are other technologies also, which are still very early. For instance, there's something called flash joule heating of coal fly ash, which creates a material which can substantially reduce the amount of clinker. But then again, these are still very early stage, so it's difficult to say. But yes, work is going on. It will take some time, however, before this can enter into the stainless cement industry in a very big way.
Sure. Thank you. Thank you so much. And this one, Jigarji, I would like to pose to you. So one of the attendees is asking, how is the companies progressing on the clinker conversion factor in the industry? And what is the transition that the sector may see from a blended cement, PPC or PSC versus the OPC as we move ahead, because maybe the question is coming from a perspective, there could be a more infra-led demand is what we're talking about, though the majority contributor would remain the real estate. I think, maybe the participant kind of did not see that the bedrock would be the real estate, but maybe, since the CAGR growth of the infra is going to be higher, so how is going to be the clinker conversion factor or maybe the blended cement proportion in the overall industry?
Yeah, sure. So this is a very valid question, and gradually we have seen in last couple of years, if you are seeing the large balance sheets or large performing companies, that blended cement performance has actually started reducing. Okay. So, and because of largely the pressure for the consumption, extra demand that is coming from the infrastructure segment, and majority of the segment, and even in the urban sectors also, that the all the RMC players are also taking the OPC cement. So that's why the consumption of OPC cement has increased. So overall, the level has actually couple of percentages reduced, and overall level also for blended cement. Going forward, definitely it will lead in the similar ratio, even if that we anticipate that the and we all are keeping thrust that the infrastructure followed by the industrial, both are primarily taking the OPC cement. Okay, so that's why the pressure will continue to remain on the blended cement ratio. And on an overall level, it will continue to be in the range of 60 to 65%, somewhere around 65% for a blended cement. Will not see any major upward trend in the blended cement ratio. I don't foresee this ratio will continue, and
Okay.
this is more in the hands of the regulatory, that if you all believe that the PPC cement is the one which is capable for all the aspects, then we can have only one type of cement, blended cement only with it rather than OPC.
Okay. Thank you so much. And Mr. Tuteja, maybe I'll post you this last one. The participant would like to answer. So, a question, sorry, I would like to understand from a region perspective, what are the high growth regions? And this one specifically is to you only is posing, which are the high growth regions that you see from a sector perspective? We've seen a lot of capacities come up in East recently. So East would continue to be the grow, or probably Central, kind of having going to have a higher CAGR from an Eastern region perspective. What's your take on it?
If I see the overall medium to long term, definitely East, Northeast, I think they'll do definitely better. But if I see next 1.5 years, Center is also going to do very, very well, considering the UP elections coming in 2027 beginning. So next year, I think a lot of spending which we witnessed in Bihar this year, that is going to happen in UP, and that's a very large market. And, a lot of spending is going to come there.
Okay. Great. Thank you so much. And I'll just thank you for answering all our questions as well, and for being very patient with all our audience questions as well. Over to you, Kabir, for the closing remarks.
Thank you, Ravleen, for moderating the session. Once again, thanking all our guest speakers for their insightful views. It was a privilege to host you. And lastly, thank you all the participants for taking the time out and being a part of this CareEdge webinar. For any further queries, feedback, or suggestion, please write to us in the feedback mail. Goodbye for now. Request the tech team to kindly log off.
Thank you so much.
Yeah,
Thank
thank
you
you
so
so
much,
much, and
Jigarji.
thank
Thank you,
you,
Jigarji.
Thank you.
Thank you.
Mr.
Thanks,
Shah.
Babu.
Thanks.